Around the world, nearly every barrel of oil you buy is priced the same way, in US dollars. From Saudi crude to North Sea Brent to West Texas Intermediate, different oils, different places, one currency. This didn't happen by accident. It's the result of history, habit, and the hidden plumbing of global finance. Understanding it explains why the dollar keeps its power, and what it would take to change that. When traders say, oil is priced in dollars, they mean the benchmarks, Brent and WTI, quote price as dollars per barrel. These benchmarks set a starting point for millions of daily deals. Even if two parties settle later in another currency, the number they start from is almost always in dollars. Why those dollars? Partly because of timing. After World War II, the US ran the world's deepest financial markets and most stable payment rails for commodities that move across borders. You want a currency that's easy to hedge, easy to borrow, and easy to move. The dollar fit all three. The system locked in during the oil shocks of the 1970s. As prices surged and OPEC grew more powerful, the US and Saudi Arabia struck an understanding. Saudi oil would be priced in dollars, and in return, the US would provide security and a reliable market for Saudi exports. Other producers followed. Once the world standardized on dollars, switching became hard. That's the key, network effects. The more people who use dollars for oil, the more liquid the dollar market becomes, and the safer it feels to everyone else. Here's how it works today. Step 1, pricing. A producer posts an offer linked to Brent or WTI, dollars per barrel. Step 2, hedging. Traders hedge price risk using futures and options, also in dollars, because those are the deepest markets with the tightest spreads. Step 3, payment. Banks move money through dollar systems like CHIPS and Fedwire, and through offshore euro-dollar banks, dollar deposits held outside the US. That offshore pool is massive, which makes large, fast payments possible. Step 4, recycling. Finally, the exporter has a pile of dollars. They buy equipment, invest abroad, or purchase US assets like treasury bonds. That's called petrodollar recycling, and it helps keep global demand for dollars high. The dollar won, not just because America is big, but because America's financial markets are big, regulated, and open. Oil is volatile. If you're selling billions of dollars of crude, you want deep lenders, strict contract law, and courts that will enforce it. You also want to hedge instantly in huge size. That combination lives in dollar markets. Could oil be priced in euros or yuan? Sometimes it is. There are small deals and new contracts, but they face a chicken and egg problem. Without lots of users, spreads are wider, and hedging is harder. Without good hedging, big users don't switch. So what would it actually take to move oil off the dollar? First, a rival currency with equally deep markets, trillions in safe bonds, active futures, and a web of banks that can settle instantly. Second, trust in the rules, convertibility, clear property rights, and courts that protect foreign investors, even in a crisis. Third, enough momentum to overcome habit. Once your entire supply chain, from pipelines to shipping to insurance, is built around dollar contracts, changing everything is expensive and risky. We've seen pushes before. The euro launched in 1999 with credible institutions and huge trade flows. It took market share in some areas, but oil pricing hardly moved. Newer contracts quote prices in other currencies, and some countries do bilateral deals that settle outside the dollar. They matter, but they haven't replaced the global standard. The reason is simple: scale. No other currency yet matches the dollar's combined liquidity, legal reliability, and reach across every part of the oil trade. If dollar dominance did slip, it would likely be gradual. First, more regional contracts and more settlement choices. Then, hedging tools deepen around those choices. Over years, not months, the mix of currencies and energy trade could diversify. But even in that world, the dollar would probably remain one of several pillars, because once a system this large is built, it doesn't vanish. It adapts. Oil is priced in dollars because the dollar offers speed, scale, and safety, and because millions of decisions over decades reinforce that choice. The petrodollar isn't just a price tag, it's a network of contracts, banks, and expectations that keeps the world's most traded commodity moving. If you found this useful, you'll like our deep dives on global trade. Thanks for watching.